What's going on, guys, and welcome back to another video. Now today's video is going to be slightly different in that I'm going to be giving my reasons for why I am not buying a particular stock rather than reasons for why I am buying a particular stock. And that stock that we're talking about is Alibaba. Now for anybody that has watched any of my previous videos, you will know that I am bullish on Alibaba and I love the business. I love where I think the business is heading and I love the valuation of the business. With that being said, a few months have gone by and the stock has absolutely plummeted, right? So we can see over the sort of last 6 months, it's down 48%. And so naturally people have been saying, have I been buying more? Have I been adding to my position? And the answer to that initially was yes. And the answer to that now is no. And then sort of second question is, well, you know, if you loved the stock at say $190, or if you liked the stock at $190, then you should absolutely love the stock at $118. And I agree with that. Absolutely, I agree with that. But there are other considerations that need to be made before making a stock purchase rather than just really loving the stock, right? And I thought I would go through some of those reasons today and see where we land with that. But just before we dive into those reasons, I thought it would be a good idea to scan over a couple of the key slides from the investor presentation, just to give you a sense of why I am so impressed by the business and why I continue to be impressed by the prospects for the business going forward, despite all of the FUD that exists for the business and for China as a whole. Now, I'll try and keep this very brief, and I say that all the time and the videos end up being really long, but I will genuinely try and keep this brief, so let's get into it. So this slide here shows Alibaba's annual active consumers split between international and China. Now, when everybody thinks about Alibaba, they think about the Chinese economy and how much that is thriving, and all of that is very good and well. But they fail to consider the fact that actually Alibaba is it's a global business, it's an international business, and that international business is actually growing at a rapid rate, right? So they've actually got a total of over 1.2 billion users, and the majority of those are within China, but actually their international user base is growing at a much faster rate. So while their Chinese user base is growing at around 15% per year, their international user base is growing at over 35% year over year. So that is absolutely significant growth. And as Alibaba can continue to sort of diversify their business and diversify away from solely China, that is obviously going to be great for the business. Not only from a brand recognition perspective, but also diversifying away from their reliance on the Chinese economy and the Chinese people. And as a result of that international push, they've been able to grow their international commerce business by 47% year over year. And that is still actually just a drop in the ocean at 58 billion RMB, compared with their Chinese commerce business at 650 billion RMB, which actually also grew by 41%. You've then also got the cloud computing space as well, which again is growing at rapid rates at 37% year over year, but we're seeing there 69 billion RMB as well. Now, so clearly there's a massive scope for growth in the business. And honestly, I don't think I want to spend too much time on the fundamentals of Alibaba, because I don't think that there are too many people here that will be willing to bet that Alibaba's fundamentals don't show that the business is undervalued. I think everybody knows that, and actually more people are concerned with the sort of geopolitical risks that exist for the business. Not only Alibaba, but also other sort of Chinese businesses, specifically Chinese tech businesses. Now that's fair enough, and I've got a video specifically on those risks, so I won't go into too much detail here. In fact, I won't go into any detail at all, because I'll just be repeating myself. But there's a number of reasons why I think that over the long term, those risks will actually go away. And actually, with that being said, the risks don't actually need to go away. And I'm referring to the geopolitical risks here. It's actually more that the perception of those risks within the market to the prospects for the business need to go away in order for effectively the stock price to increase again and for Alibaba's actual price to align with its intrinsic value. And the reason I say that is because all of the risks and the geopolitical risks which exist for Alibaba today also existed for Alibaba when they IPO'd, right? These are not new risks. And I'm talking about, or I'm referring to, the variable interest entity risk that exists, the fact that the Chinese Communist Party aren't exactly willing for foreign investors to freely own the business in a format in which we are used to over here in the Western world. All of these remain now, today, in the exact same form that they did 5, 6, 7 years ago. And despite that, the market was very exuberant about Alibaba, throughout period of history, right? So we can see over here, over a few years, a couple of years, we saw a 100% increase in Alibaba's price, despite the fact that those risks continued to exist at that time. Now, admittedly, there have been further changes to the risk profile, or at least the perception of the risk profile, since that period of time, which has resulted in a massive sell-off and thus a decline of 62% in the share price. And there are many reasons, but the primary ones being the fact that the Chinese Communist Party suspended the Ant-IPO, and that happened around October. And then on top of that, the Chinese Communist Party also effectively forced businesses such as Alibaba and Tencent to make donations to what they term common prosperity. And shareholders didn't like that because effectively they are stealing the profits from shareholders. That is ultimately how you should look at that. And so, effectively the sell-off is potentially warranted. It probably is warranted because there's a lot of uncertainty around the stock. And so that leads me on to my sort of following point. And that brings me on to the point of the importance of diversification. Now, diversification, of course, is important for a number of reasons, with the primary ones being the fact that we can be wrong, or we need to recognize that we can be wrong within our analysis. And therefore, when we believe a stock is undervalued and therefore a buy under a particular set of circumstances, we may be incorrect in that assumption. Number two, the fact that we need to also understand that new information can come to light after you have made an investment, which later results in your investment thesis effectively going by the wayside, which again sort of draws back to number one, which would be that your initial thesis was wrong. And then the third one being that markets are very rarely rational, and actually they are hardly ever rational in the short term. And I think that we are seeing that play out with Alibaba, which I believe is evidenced within my valuation for the business, which I continue to adjust depending on changes in the fundamentals of the business, as opposed to changes in the fear, uncertainty and doubt that exists in the media, right? With that being said, we've got revenue growth of 22 and 19% respectively for years 1 and 2, and then we see 3 to 5 year revenue growth of 16% and 6 to 10 year revenue growth of 12%. Now, bear in mind that this is a business where we're used to seeing them grow at anywhere between 35 and 58% over any given year. So clearly we're being quite conservative there. Now, I'm not going to run through the entire model here because I've done it in previous videos. And despite the fact that some of the numbers have changed, the basis around the valuation remains the same. And so we've also got a Chinese Communist Party Common Prosperity Pledge, which has already been effectively committed to, where they're expected to pay 100 billion RMB over the next 5 years. And I've actually incorporated that in, but I've also assumed that this is going to be something that actually continues effectively into perpetuity, despite the fact that we haven't had any news on that. That leaves us with a net profit margin in 2022 of just 14%, and that is expected to increase, according to my model, up to 17% by 2031, despite the fact that actually net profit margins were 20% in the year just gone. And then the discounted cash flow model is equally conservative, where we've got EBITDA margins of just 22% going forward, despite the fact that actually 27% was achieved last year. And although we have knowledge that EBITDA margins are going to decline as they continue to invest in different businesses, over the long term, we're actually expecting those EBITDA margins to tick up again. And therefore, I'd actually expect EBITDA margins to be slightly above 22% by the time we get to sort of 2030. But to remain conservative, I'm leaving it at 22%. Similarly, with unlevered free cash flow as a percentage of EBITDA, I've gone with 75% in the model, despite the fact that actually the average over the last 5 years has been 80%. And then similar to the income statement, we've also included the CCP donation, not only for the years which we have confirmed in which the donations need to be made, but also beyond that as well, to remain prudent. And also those donations are increasing year over year. Now, despite all of these very conservative assumptions, we can see that we get a fair value of around $153, which is a margin of safety of 30%. If we flick across to my enterprise value to EBITDA price target, we can see a 2026 price target of $288, which would imply a compounded annual growth rate of 25% over that period of time. And that is using a relatively conservative enterprise value to EBITDA multiple of just 13. So once again, naturally, the question comes back to, if you really like the business and you really like the valuation of the business, where you think that you can earn a return of 25% on a compounded annual growth rate over the next 4 years using some relatively conservative assumptions, then why would I not just be loading the boat? And that's a fair question, but the answer comes back to, once again, diversification. Now, there really are no right or wrong answers when it comes to diversification, and in particular, how many stocks does one need in order to be well diversified? But here's a question that is often asked. So what is the ideal number of stocks to have in a portfolio? Now, you'll often hear the number of around 20 stocks thrown around. And we can see here, while there is no consensus answer, there is a reasonable range for the ideal number of stocks to hold in a portfolio. For investors in the United States, the number is about 20 to 30 stocks. So that would suggest an allocation towards each stock of somewhere between 3.3 and 5% if they're going to be equally weighted. Now, of course, they don't need to be equally weighted, but it goes without saying that you can't just have one stock at 90% and the remaining 29 stocks at 10%, because clearly then you're not getting the appropriate diversification, right? It kind of defeats the point. So to keep it simple, let's just suggest that every stock should be equally weighted. And this actually takes me back to my days of having to study finance for my profession. And we can see here that actually it's summarized quite nicely in a chart. But before we get onto the details of the chart, you need to understand one thing. And that is that diversification in particular stocks actually only protects you from one kind of risk, and that is specific risk. In other words, risks which are specific to a particular company. The other type of risk is systematic risk, and that is a risk that is assigned to absolutely every company, which cannot go away through diversification. So an example of that is a recession. Now, generally speaking, in a recession, all stocks will perform badly. And I know that that isn't strictly true, and that's probably not a good example, but you get the point of where I'm coming from. So ultimately, this chart here, which shows portfolio standard deviation on the y-axis and number of securities along the x-axis, we can see that the point in which unique risk is actually eliminated to zero, and we're left only with market risk, is around the point of around 20 securities. Now, does that mean that I stick to that principle by gospel? Well, no, of course it doesn't. I'm not necessarily going to hold 20 securities, and I'm also not necessarily going to equally weight all of my positions. In fact, I will never equally weight all of my positions. But it does go to say something, which is this. If you have a particular allocation towards a stock based on whatever sort of circumstances that you decide, it's important that you stick to that allocation. And effectively what I'm saying is this. I decided when I entered my position that it was going to be a certain allocation within my portfolio, and I would leave a little bit of room so that I can average down on the position should I get the opportunity to do so. But once my position is full, I will refuse to continue to add to it. And the reason for that is because, like I said, it comes back to a point I was making earlier on. We can be wrong in our analysis, and as a result of that, we want to remain fully diversified, or at least reasonably diversified. If we continue to put money into a particular stock just because it is falling, then you get the problem of the you get the problem of the falling knife effect, right? And we all know what sort of result that leads to. So in a roundabout way, what I'm saying is that although I believe in the business, although I believe in the prospects for the business, and although I believe that the geopolitical risks will subside eventually, and the valuation of the business will therefore increase as a result of that, I'm not willing to continue to increase my risk allocation to Alibaba or any stock like Alibaba, just in case that my personal analysis is wrong. And I think that people should make sure to do the same thing. Now, that of course is not me necessarily saying that you shouldn't be adding to your position, but if you decided on a particular allocation towards a stock and you had a ceiling for that position, then you shouldn't pass it just because the price now looks more attractive, because ultimately we can all be wrong within our analysis. Anyway guys, I hope you found the video useful, and until next time, thank you.